please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to this special coverage of the JP Morgan India Investors Summit. It is their third India Summit. The conference spanning over 2 days is going to see attendance from the biggest policy makers, ministers, and of course, even corporate decision makers and global investors. The JP Morgan Summit cannot have come at a more interesting macro situation. Interesting is, of course, a euphemism. It's a trying macro situation. And therefore, it's more important that we listen to these people who have seen many cycles like this. I have with me Kalpana Morparia, the CEO, South and Southeast Asia, Bharat, Iyer, Head of Equity Research, and rather more important today, Sajjid Chinoy, the Chief India Economist, all from JP Morgan, of course. Gentlemen and gorgeous lady, thank you very much for joining us today. Well, because of the situation, I'm starting with Sajjid. Sajjid, you know, the market has responded to that package of measures with a further fall in the currency, not touching Wednesday lows, but still, you know, 72.5 on the currency. What's your sense? Do you think we just go with the emerging markets irrespective of what the government does? I mean, all EM currencies are lower.
Yes. Exactly. I think that's the point here, that over the last 48 hours, all EM currencies are lower. Asian currencies, many of whom are current account surplus economies, are also weaker today. So India is simply mirroring that effect. I'd like to make 2 points, which we've discussed before. One is that some amount of rupee depreciation was inevitable in this global environment. I would argue it's healthy. It'll help correct these growing imbalances externally. So we should not panic. And I'm glad to see the government and the RBI are not panicking. Now, there is a balance here between allowing a calibrated depreciation and not letting entrenched expectations grip the market such that you get self-fulfilling expectations. And I think maybe over the last 10 days, we've occasionally seen signs of that. Exporters are not hedging, importers are front-loading. So there are things that policymakers can do to reverse those expectations. My sense is what you saw over the weekend was just a start. There was a clear commitment to staying on the fiscal course.
Yes.
There was a belief that we've got a big battery of measures we can introduce. Let's not bring out the bazooka right now because it's too premature and not necessary. So I think we should just take a deep breath. If India moves with other emerging markets, I think it's par for the course because we don't want our trade-weighted exchange rate to appreciate any further. We've come off a 20% appreciation and we've seen a 6% depreciation this year.
Okay. Yeah, I guess I'm talking in terms of, you know, we are making up for 3-4 years of stability or even real effective appreciation would be perhaps helpful at this juncture. I'm going to come back to you with lots more questions. Well, one question to you, Bharat. You know, at some point, India would become attractive. I remember that in 2013, one fine day, I think it was April 28 or 29, the rupee just stopped falling. Yeah. I mean, the stocks have fallen considerably. Well, not at this moment, it's not considerable. It's perhaps just 5% from highs. But a Reliance and a TCS are cheaper by about 10-12%, you know, compared to last 2 or 3 months. At some point, considering that you would have spoken to a lot of investors ahead of your conference as well, does India become attractive for an equity investor?
It does. I guess, you know, what we have to appreciate is structurally India is still one of the best emerging markets out there, be it in terms of the medium-term growth profile that we have. Near term, we have seen some cyclical headwinds, particularly because, you know, oil really was on a rip and that has impacted all the macro variables. But again, as Sajjid has pointed out, you know, the depreciation in the rupee within an extent is actually par for the course. And actually, you know, corporate India is not going to fret too much because, Lata, we have to appreciate that we need a competitive currency not only to boost exports, but also to protect our domestic industrial complex from imports.
Absolutely.
I mean, look at the number of industries which have asked for protection in the last 2 years. Steel, carbon black, tires, rubber, I could go on. So, you know, quite a few of them would actually, you know, welcome, you know, the rupee depreciation within nominal levels.
Oh, yes, absolutely. And there were some economists and strategists pointing to us that after every depreciation, sharp depreciation, you have seen 1 year later Nifty earnings do much better. And I'll come to you for some numbers if you have already taught some. Mrs. Morparia, you know, you've been a veteran of a couple of these cycles. You know, we saw it in 2013, before that in 2008, and of course in the late 90s as well.
Way back in 91 as well.
Oh, yes. I don't remember that very well at all. What's your sense? Is this a situation where we are radically different? The guests you spoke to while inviting them, what sense do they exude of India?
So I think India is radically different from 2013. In 2013, as you know, we were one of the infamous fragile five. Since then, India is far more stronger than before. Sajjid actually has been saying this for the last 2 years, that this real effective exchange rate appreciation of the Indian currency is certainly not helpful for Indian industry at large and for the country. All of us were lulled with oil at 40. And if you look at last year when we had the conference, our big worries was certainly not macro. It was all about banks being undercapitalized. Will GST kind of settle down? Will IBC really play out? But such is human nature, Lata, that we don't talk about any one of these three successes 1 year down the line. But, you know, the currency gyrations is what's completely on everyone's mind.
Okay. Well, fair point. But at the moment, that will be, I guess you will be the top draw, as will be, of course, you know, Jahangir and your external team. What are they saying already? You know, Sunil Garg, James Sullivan, the people who look at India as part of the EM basket and who look at EM very closely. Are they saying that this pain will endure? After all, the Fed tightening has, in a way, probably been only midway. They're probably in the middle of a curve.
Exactly.
What are they saying?
I think that's the point. I mean, we have to we don't live on this island. Step back, and emerging markets, the analogy I use is, have been living on a ventilator in the last 7-8 years. That ventilator has been this unprecedented accommodation of central bank balance sheets. That's now changing. So I think what EMs are caught between are two dynamics. One is US exceptionalism. The fact is, growth in 2018 has been very desynchronized. The US has grown at 4% in the second half, growing at 3% in the second half of the year. Wages have finally gone up last week. The unemployment rate is below 4%. This is an economy that's steaming along. The problem is that the rest of the world is not keeping to pace. So when you have the largest economy in the world growing above potential, where the central bank will have no choice but to raise rates meaningfully aggressively once a quarter, we believe, for the next year and a half, at least till they get to neutral and further. And you've got China, which is actually slowing, and investors aren't seeing tangible signs of a fiscal stimulus. Emerging markets are caught in between. So you've got, you know, you're on a highway and the car ahead of you is slowing down, which is China, and the car behind you is accelerating, which is the US. You're caught in between. So what you'll need to see, I think, is policymakers being nimble, being proactive. But let's not forget, in a world which is worrisome, India's fundamentals ultimately will shine through. Inflation is running below 5% in India. The current account deficit is, yes, high at 3%, but not at 5% like 2013. And we've seen the biggest improvement in our twin deficits in the last 5 years. So when the dust settles, markets too tend to be more discriminating. And I think we have to hope for that we are not one of those fragile economies. There are many other examples right now. We have to be, I think the key is, be orthodox. Stick to your fiscal target, raise rates if inflation warrants, and I think the rest will take care of it.